it's tough. I get a lot of conversations with clients as well as with the lender saying, close quickly, close as soon as we get the appraisal in, no delays. I can only lock in this rate because banks are unilaterally just raising their interest rate, even though, market is maybe 5% right now. But lenders are just pulling back from their original term sheet or original parameters and saying 5.5, because our bank has a 90% probability they're going to raise the rate half a point before the end of the year.
This is your daily real estate syndication show. I'm your host, Sam Rust. Joining us today is Ron Rohde, who's the founder of a commercial real estate law firm in Texas that focuses on helping investors buy commercial real estate to build wealth. Ron became a real estate investor before becoming a lawyer, and currently combines his career and passion for helping people achieve their goals. Ron, thanks for joining us today. Welcome to the show.
Thanks for having me, Sam.
So you got your undergrad from Cornell, and then you go to Miami for your JD. That's not a typical path. What's the story behind that?
Well, for me, it was, going to New York, going to the snow and looking for the complete opposite, too much snow, and then go for the sand and the beach. Yeah.
Yeah, that's two very diverse locations. And then what brought you out to Texas and get started? I know you mentioned before we got on air that you focus a lot in the industrial realm. And you mentioned in your bio that you focused on investing before getting into practice. What was that journey like?
Yeah, I'm originally from North Texas. So I always knew that I wanted to, so to speak, raise a family, do that. I was practicing in Florida for a little bit. I got a job opportunity to come back to Dallas, so I took it. My parents have always been investors, so they invest in commercial, residential, notes. They've kind of done it all on the spectrum of investing. So I've learned from that. Yeah, I just came back, did that job. I was general counsel for a real estate developer doing kind of ground up multifamily construction. We were doing build for rent before it was cool. We built like 68 duplexes out in Houston, so that was a fun project. I've had my own firm for 5 years. And it's been fun. I love helping people who use commercial real estate or real estate investing to grow on their journey. It's just exciting for me to talk to people every day.
Yeah, fantastic. So you mentioned industrial investments. Are you joining in on other syndicators? Are you sourcing your own deals? What does that look like?
Yeah, so we have a couple partners. All the stuff that we buy is not just me personally, but we're not doing formal, Reg D offerings, 506. Usually just a couple buddies we'll pull together. So right now we have about 100,000 square feet of single tenant net lease buildings across DFW, all fully leased. We're looking to renew one of them right now. So that guy, he knows he's in for an eye opener. That should increase the cash flow a bit. But yeah, so sold all the residential stuff, transitioned into industrial, and I've loved it. It's been fortuitous. Maybe I should have gone into multifamily like you guys, but I'm happy with industrial so far. Yeah, that's where we are.
So in the industrial space, you tend to have longer leases, which is kind of a double-edged sword. It can be good in a stable environment, in an inflationary environment, maybe not so good. But you're turning over a lease now. I'm curious, if it's been a 10-year tenant or something approximating that, their lease may have gone up 50, 75% on a per square foot basis. What's tenant retention like when you get to that? Because I would imagine that industrial, especially single tenant, like what you're investing in, is fairly sticky, but there's got to be, as you mentioned, some sticker shock as well. What's been your experience in that?
I'll comment on the first part of your statement. I definitely agree with what you're saying. It's absolutely correct. The difference between something like a multifamily or like retail, you have opportunities to market your rents a lot more frequently. On the flip side, for multifamily and a gross lease, you have to have some way to control your expenses in an inflationary environment because you can get nailed on property taxes, insurance, and that sort of thing. So for triple net, yes, you cap your upside in terms of a longer lease term in an inflationary environment, but you're also capping your downside because we pass through property taxes, insurance, so our downside is also really capped or there's a floor. So just given the full picture of kind of like why we made the decision or what the pros and cons are for these triple net, yes, you kind of have a band of gain, and it kind of projects out like this. Your upside is capped for the next couple of years, but your downside is also capped, assuming the tenant stays and is solvent. To your second point, Yeah, this particular building is leased to a larger, I'd call it a large regional. They're not publicly traded, but they have audited financials. They have several hundred million in revenue every year. So this cost as a percentage of their total expenses is pretty small. And for us, they've actually been kind of tipping their hand. I don't know if their real estate negotiation and their operations were kind of on the same page, because they're in the process almost about to renew. And they just installed a $40,000 fuel tank to resupply trucks. And I mean, they spent $40,000 in insurance, both installation insurance and like operational for that fuel tank. It's above ground, thankfully, but they requested all the permissions. They gave us all the plans and all that process, and they did that right before. I'm like, wow, you're going to spend $100,000 on this fuel tank right before lease negotiations. Not going to help a ton when your real estate guy says, we can find cheaper space. I'm like, yeah, well, you just installed $100K.
The sunk cost will be working in your benefit at that point.
Yeah. And they're a good tenant. They spent a lot on their build out. They're putting more money into their office right now. So I guess bigger picture, what we're trying to do is, look, you have a renewal. It's at fair market value. So you're going to send the option to extend, and we just really have to figure out what the number is. I think by taking one more variable off kind of makes it a little bit easier, because then we're really looking at apples to apples. And to your point, you said this was a 5. So they did 1 5-year with 2 5-year renewals at fair market. So that's really what we have. They say we'll agree on another 5 years, but what's the rate? What's market? And now we can look at comparable spaces that are offering 5-year terms. So they can't just show us like a 10-year lease that's a lower base. Well, I don't know. In this environment, it's crazy. I'm going to show them a 1-year lease and be like, that's comparable to a 5-year, because no landlords want to even sign long-term leases that lock them in.
Yeah.
So.
Yeah, especially in DFW. I mean, ground zero. I know a lot of folks that are investing in industrial, in multi-million square foot, portfolios, and it's just ridiculous what has happened. It traditionally was a very stable and not very sexy. Like you said, the floor is high, the ceiling is a little low, and you're just coupon clipping. But the coupons have been extremely big over the last couple of years, especially in Texas.
For sure. And that's the thing, we kind of play in that smaller space because, just to add on to our thesis, they're building tons of new construction, but it's all these bomber buildings. It's all 500,000 square feet, 300,000 square foot buildings. They're not building replacement product for 100K or below. And so those tenants that don't need a full 100 and prefer a single tenant, maybe with a yard, and they kind of have that utility of being a single tenant, there's just no replacement product because it's just not as cost effective. So we hope that's just going to put upward pressure on the rents, because we're completely below the new construction stuff at 1 million square feet. So.
Yeah, certainly. So I was looking at your background, and as you mentioned, you worked for a couple different law firms, and you struck out and started your own law firm. And it looks like went full time in October of 2020. What pushed you to go in that direction and strike out on your own?
Yeah, I think it all relates back to the investing and what I want to do with my time. Hopefully I'm thankful enough that I kind of realize, your time is your most valuable asset. And for me, having my own firm allows me the flexibility to provide the type of legal service that I specifically want to provide to my type of investor client, as well as having the freedom, like on a Thursday, I'm gonna duck out of the office for 2 hours. I got to drive to talk to a tenant, trying to get to re-sign on this on a different property. But I can just do that kind of at the drop of a hat. I mean, I scheduled it today, but if I was with a larger firm, I may not have that flexibility to pursue or, take care of my own investments. So
that's fantastic. I noticed that you're also starting a YouTube channel. Why YouTube? What kind of content are you trying to deliver, and what's the thesis behind that?
Yeah, definitely plug for that. Smash the like button, subscribe. So this was during COVID, we were kind of locked down and back at home. I kind of did a survey of different social media. I knew I needed to get online. I needed to get that digital presence, whether it was like paid Google ads or Facebook or Instagram, Snapchat, I don't know. But I settled on YouTube, really because for the longer format, people these days, in my experience, they go to Google, they type in something, they would rather watch a video from a friendly face like yourself to learn how to do something as opposed to reading a 2,500 word article. That's just not convenient. That's not what people like to do. They like to put the ear pods in and listen to a podcast type of thing and learn about something. So that's what drove me to it. Plus the fact, Google owns YouTube and they prioritize Google feeds over to YouTube. So that's a kind of win-win on that side. So yeah, it's been 2 years for the YouTube journey, but it's been great. I get a lot of great interaction and feedback from people that watch the videos.
Oh, that's fantastic. Your videos are pretty well done. I'm curious, are you bringing that production in-house? Are you working with a third party? How does that part of the process work?
Well, I appreciate that. You probably selectively looked at good ones, but don't go too far back. If you go, back in the years, then it gets pretty embarrassing. No, I do a mix. I've had third-party editors. I edit a lot myself. I have the software. I do the B-roll and stocks. I don't know. I haven't found a happy medium of that, but I will say anything good is from a third-party guy, and if it's terrible, it's probably me. It's just tough. I follow some of the big YouTubers, and they talk about it. Some of the big guys, like million subscribers, they still edit their own stuff. Like Graham Stevenson, he still says he edits. He edits every single one of his videos. And, it's that kind of control or micromanaging. That's just one thing that he still really likes to do. So I'm torn. I go back and forth, like time versus money. I do a little bit of both right now.
Yeah. I started my own podcast many years ago that was not connected to real estate. And my buddy and I did some of the editing ourselves. My buddy did more of it than I did. But being involved in that process, I think it's helpful. And then very quickly, you're like, you start having the time versus money argument in the back of your head. It's like, maybe I know enough to be dangerous and I can oversee someone else doing this work.
Yeah, for sure.
Well, I would be remiss, Ron, to let you go without at least touching on some stuff related directly to your profession. And one of the questions that I wanted to touch base on that might drive some value for folks is around loan terms, loan covenants, and specifically, especially when you're dealing with banks and credit unions, there's a lot of retrading going on out there because of all the interest rate volatility. So from your perspective, you're working in commercial real estate day in, day out. How can operators and investors protect themselves as best they can in such a volatile environment and try to get to the closing table with a deal intact?
Yeah, absolutely. It's the wild, wild west right now. I have no, love or particularly affinity for lenders, but
they're a necessary part of our business, right?
They're a necessary part, and they move things along. But, they really move in locks. They're, to me, the ultimate example of herd mentality. They will loan what other lenders are loaning at. They're always curious what other people are doing. I'm like, why can't you just do your own underwriting, your own borrower? If you like the property, you can be the only one that pushes out a loan, and you'll be the only one that makes money. And they say, no, that's not what we want. Because what we're seeing is just a lot of uncertainty, both on the rate as well as the bank's risk appetite. And those are the two things that really can kill a loan, and as well as killing DSCR for borrowers, is understanding what the cost of that capital is, and maybe to a lesser degree, like some of the amortization is just pushing up those monthly payments, and then it busts, like a 1.2 or a 1.25, something like that. But what we're seeing, even on the industrial space, is probably a little bit of pulling back of LTV. We were pretty aggressive at 80 for a while, and you could get any kind of industrial with a halfway breathing tenant to get 80% LTV, and all the super low 3%, 3.5% rate. But now it's tough. I get a lot of conversations with clients as well as with the lender saying, close quickly, close as soon as we get the appraisal in, no delays. I can only lock in this rate because banks are unilaterally just raising their interest rate, even though, market is maybe 5% right now. We'll date ourselves in June of 2022. It's like 5%, but lenders are just pulling back from their original term sheet or original parameters and saying 5.5%. Because our bank has a 90% probability they're going to raise the rate half a point before the end of the year. And these are longer term debt, fixed debt. So for like a 7-year term, they're wanting to hedge something they think is very likely. So for like a 7-year fixed term, they're just bumping it to 5.5. And you as a borrower, it kind of pulls the rug out from you. Right? You may not hit your returns. Worst case, you can't even, cover debt service. You got to raise your equity, decrease your LTV, and suddenly you're at 68% LTV. I mean, I get it. Yeah, it helps, but it's not what you underwrote for. And you still maybe need to do some value add. It's tough. So my advice, I guess, for everybody is it doesn't matter how much your representative at the lender says it's locked in until they go to commit, until they have that approval. I would really continue to factor in a fudge factor. Maybe we're seeing more financing contingencies come back because those are real deal killers. And, you can say, if I don't get interest rates below 5.5, I'm going to kill the deal. I think most sellers will probably sign that because they're laughing. They're like, okay, yeah, rates are at 5% right now. You're fine. 5.25, maybe you'll still close. 5.5, you'll still close. But it may give a hedge and let you get that earnest money back, even if you're past an inspection period, due diligence inspection period. So
I think you touched on something that I've seen firsthand. Speed is of utmost importance right now. Hopefully no one's executing on a refinance right now, but for purchases, getting your third parties done and in order and avoiding all stickiness along the way from the buyer's end will only serve you well. Lenders are pretty quick to toss overboard the people that are difficult to work with. The power is in their hands now. It's not in the borrower's hands anymore.
And that's a great lesson too. I have a former boss, like a mentor. He was telling me, back in like 2012, 2013, 2014, lending was really, really dry. I mean, we were doing new construction, multifamily. We could not get construction loans like above 55% LTC. It was insane how little the lenders were pushing out because they were scared. Everybody was. But fast forward to 2019, 2020, lenders were bending over backwards, giving you 80%, 85%. They just wanted to push money out. If you were building multifamily, blank check. Doesn't matter what your feasibility says, your demand, your business plan, your rents. They were just like pushing money out.
Where do I sign?
So my mentor said, it's your duty as a real estate investor. You have to turn the screws back on the lenders because they won't hesitate to screw you over, and you have to screw them over back when the tide turns and pick up that 80% refinance non-recourse and just lever up your properties and say, okay, good luck now. I've got my money tax free. If I can't raise the rents the next couple of years, you can have the property back. I've got nothing. I've got all my money out. It's an interesting approach, but I definitely have more understanding of where it comes from now that I see a lot of these borrowers, right, getting pinched and put in really bad positions by the lenders that just kind of shrug their shoulders and they say sorry. And we'll say, well, we're going to remember that because in 3 years, in 4 years, when you're chasing us for loans and you're begging us to give you a shot, I'll be like, no, we remember 2022.
Yeah, that's certainly true. These things go in cycles, and we've just seen it flip with pretty crazy speed, I would say. Saying that not as a veteran in the industry, but just looking at past cycles, it feels like there's always been tipping points, but this one has been just very quick, and there's a lot of competing factors. What's going to win? Interest rates or inflation, particularly when it comes to multifamily, and I think the jury is still out on that. If you're up for it, Ron, I have a couple questions here. Would love to just do a lightning round on a couple of legal things if you're up for it.
All right.
What's a common mistake that you see borrowers make when they're interacting with lenders?
I think not having a clear understanding of who's going to PG. So there's a lot of.
When you say PG, could you define that?
Yes, for purposes of answering this question, I'm typically talking recourse, private lenders, just kind of bank lenders, not your Fannie products. So
Sure.
This applies to tried and true commercial lending, but not knowing or having that information of who's going to provide a personal guarantee. Because again, that's kind of the space we're in. Our sweet spot's 10 to 25 million, 10 to 30 million. A lot of personal guarantees, it's fine. But then you take other partners in and there's uncertainty about who's going to provide a personal guarantee. It just kind of rubs borrowers the wrong way when they say, hey, Sam's putting in money, but he's not going to guarantee it. Because it does put a lot of obligations on you as an individual that, reporting and just, you apply for more loans and you got to disclose. They may want to talk to the other lender. That's a big mistake I see is people don't understand. They say things like, I, Ron, just want a personal guarantee. And the lender's like, well, who else owns it? If Sam is in on this deal, I want him as a guarantor.
Yeah.
So that's...
All right. What's a term in PSAs that you wish got a little bit more attention or buyers spent a little bit more time and thought negotiating?
Yeah, so this is a new one. It's kind of futuristic. We're seeing a lot more focus on intellectual property, which the term in PSAs is personal property, right? Anything that's not real property is classified as personal property. And maybe I'll get a little bit right. So when you buy most traditional of those PSAs, it's real property. You're buying the dirt and improvements. Okay, we get it. That's easy. Personal property, that's your golf cart, your inventory, equipment, tools on site. Okay, fine, we get that too. Furniture, office, that's fine. But then now we have intellectual property, which is the goodwill of the name. Maybe you have a website that's just generic, right? It doesn't have to be the beautiful view villa apartments, right? It can just be the property address with information about the location. You may have apartments.com listings, definitely Google My Business listing, emails, phone numbers. And so I wish people would spend a little bit more time just being very clear with, say, us about, not in the LOI, but in us is, do you want any of this intellectual property that's out there? Because I have had a lot of clients, they're not necessarily looking to reposition an asset with a new name. And if you're not doing a new name, then by default, you should be absorbing the existing intellectual property on the internet, right? The digital property. And they don't put as much of a focus. I have too many gray hairs chasing down sellers to get passwords, to get emails. The GoDaddy domain hosting that has the website files, they sent a reset to your email. And these people are busy, and if it's post-close, you have very little leverage to try to get it after closing. But then my clients are really chasing me, being like, Ron, we really want this. This is valuable to us because we're not going a full rebrand. We want to keep it. Now we need to access the website. The guy says you can have it, but they don't have the passwords. That's something that I think is very 21st century, or if you're savvy, you will just understand. Again, you don't need to claim it, but you should just understand that it's out there and tell me, do you want it or not? Because if you do, we're going to take some steps and make it an affirmative obligation. If you don't care, then actually, we may ask them to shut it down. But you still maybe want to buy the website and redirect it to your new website. So there's all sorts of things to consider. Takes 30 minutes on the buyer side. I see a lot of people asking that question. They're like, huh? What? Because how do you handle that? Do you guys have a methodology that decides?
So we are working on formalizing a process. We've had a couple of deals here recently that had more developed internet property rights, all those things, domains and et cetera, et cetera. We typically have been in value add and buying from legacy owners. In those two things, 70s product and people who've owned for 20 years, they probably don't have a website. But we're starting to see that more and more and negotiating that and getting everything up front. If you don't have it by the time you put your signature to the closing statement, man, the amount of pain you have to go through to get, as you testified, we're too young for gray hair, both of us. We can't have that. But you end up with some if you're not careful. And we had our very first deal with a website. This was like a year and a half ago. There was one piece, and I think it was the GoDaddy registration. But when we went to renew, we weren't the owner, and it was a disaster. Such a small detail, but when you don't keep an eye on those small details, they can become a big pain in the butt. So it's a really good exhortation for operators as technology continues to push into our industry.
Yeah, absolutely.
Fantastic. Well, Ron, what's one habit that you would say has contributed to your success? Daily, weekly, monthly, something that you do regularly that would be beneficial for our audience?
I'd say I work out consistently. Another owning the company is I try to duck out a little bit early, get to the gym, get home for dinner. But, for me, I work in the evenings, not the morning kind of, but it's consistent, right? And it doesn't matter. I'm able to prioritize at the time, but that's just a muscle, and I think whatever your habit is, doesn't matter. You need to practice that muscle and practice making anything a priority, and then just doing it every day.
Definitely working out is important. I think having a daily or even a multiple time a week habit of doing anything is tremendously helpful. It's about building the skill of diligence. And whether that's reading or working out or spending time with family, any of those things are productive when you force yourself to do that on a regular basis. Fantastic. Well, Ron, really appreciate you joining us on the show today. If folks are interested, I know we mentioned your YouTube channel. We'll throw the link in the show notes. But how can they reach out to you? How can they connect with you to learn more?
Definitely. YouTube is website is www.ronaldrohdelaw.com. RONALDROHDELAW.com. There's plenty of emails on there. So.
Fantastic. Well, thanks again, Ron. Thank you to our listeners for tuning in to another episode of the Real Estate Syndication Show. I'm your host, Sam Rust, signing off.
Thank you for being a loyal listener of the show. Please subscribe and share it with your friends. We want to help you become the passive investor you've always wanted to become, but also the operator you've always wanted to become. We want to be the number one resource for your real estate investing journey. But go to lifebridgecapital.com where you can start investing in real estate today.